So the Fed is going to be dropping the interest rates in September. So what does this mean for you guys? Where are you going to be putting your money to get the best bang for your buck? Guys, in this video, I'm going to share with you guys where Fidelity says some of the best places to put your money when the interest rate drops. And then I'm going to share with you guys what we're doing with our money. So guys, let me know down in the comments below, are you planning on moving your money, or have you moved your money now that the interest rates have been announced that they're going to be cut by the Fed in September? Guys, if you are new here, my name is Susan Velez, and on this channel, we talk about making money, saving money, investing money, and taking care of our health so that we can catch up for retirement, especially if you are late to saving for retirement like me. So the interest rates are going to get cut, and it's been announced. It's been being announced for a while now, but a lot of people think that in September, the interest rates will be cut. And if you're like me, guys, you may not have known what this means for your money, but after doing some research, guys, I have realized that if you are managing your own money, you have to find ways to move that money around without selling your stocks at a loss, guys. I'm not talking about stocks. I'm talking about money that may be sitting in a high yield savings account, or money that you have sitting in a traditional checking or savings account. If you want to beat inflation, if you want to make sure that you're making the most money on that money, you have to be proactive and move your money around. And guys, in the past, I never moved my money around. I'd put it in an account and I'd let it sit there because I had no clue. I didn't keep up with anything. But this time around, I'm doing things differently because I am trying to make the best bang for my buck. And before I share with you guys exactly what I'm talking about, let me first share an article that was written by Fidelity. So right here, guys, on this article, 5 investing ideas for falling interest rates. It says when rates fall, these classes of investments are worth considering. So the first one is U.S. stocks. So falling rates have historically been a positive for the stock market broadly, a relationship that's held true on average regardless of whether the economy is in a recession or not. Although stocks tend to underperform prior to rate cuts in a recession, after a first rate cut, stocks have typically outperformed over the following 12 months in both recessionary and non-recessionary environments. That said, guys, it says past performance is no guarantee of future results, so keep that in mind. Number 2, guys, is small cap stocks. While falling rates have historically been positive for stocks in general, they might provide a greater boost to small cap companies. Small cap companies generally carry more debt than large companies, which means that they felt the pinch of higher rates more than their larger brethren and could benefit more from relief on rates. That advantage could be particularly pronounced if the economy does avoid recession and if the small caps can delve on bullish consensus earnings growth estimates for 2024. Small caps have historically benefited more than large caps from the first rate cut of a cycle, and their advantage has been even greater when earnings also improved, says Denise Chisholm, Fidelity's Director of Quantitative Market Strategy. Number 3, guys, is cyclical stock sectors. Falling interest rates often go hand in hand with rising earnings, which historically has particularly benefited cyclical sectors. The consumer, discretionary, technology, real estate, and financial sectors have historically been especially likely to outperform the market when rates fall and earnings rise. Financial stocks look particularly appealing due to how expensive they've recently been. The median forward to price to earnings ratio, PE, among financial stocks was recently in the bottom 25% of its historical range going back to 1977, when this metric hit similar levels in the past. Financials outperformed more than 2/3 of the time over the following 12 months. Number 4, guys, is investment grade corporate bonds. Falling rates may mean opportunities in actively managed mutual funds and ETFs. Bond prices and bond yields move in opposite directions, and when interest rates move down, so do yields. This means that lower rates are likely to reward investors with rising bond prices. And then number 5, guys, is U.S. Treasuries. If interest rates come down quickly, it will likely be because the Federal Reserve hasn't managed to engineer a soft landing for the economy and is instead trying to ward off a recession. In that environment, U.S. Treasury bonds may often may offer investors an attractive strategy for helping manage through a potential recession. Treasury bonds have historically thrived when the economy has contracted, and Moore says Treasury could outperform corporate bonds, to say nothing of stocks in the next recession. If the economy avoids recession, Treasuries might not outperform other bonds or stocks, but would still offer a low-risk way to get attractive yields. So what does this all mean? Well, it means that if you are managing your own money, you have to know where to move your money to get the best bang for your buck. Because as I say, guys, right now at the time of this video, CDs, money market funds, treasury bills, and high yield savings accounts are all yielding over 5% interest. But when the interest rate drops, high yield savings accounts are some of the first accounts that are going to lower their interest rates. And the reason being is because they make their changes every month, whereas CDs and treasury bills don't make their changes monthly. Because, for example, let's just say that you bought a 6-month CD at 4.5%. That interest rate won't change until that CD matures. Once that CD matures in 6 months, at that point, that 4.5% that you purchased that CD at may not be available anymore because the interest rates are going to be lower. So that's why a lot of people are making their moves to CDs and treasury bills. And I'm going to share with you guys what we're doing. So as you know, we've been using Goldman Sachs for our sinking funds and our emergency funds, and we've had everything in that account. And when they announced that they're going to be cutting the interest rates, instead of leaving our money in the high yield savings account, we've moved a big portion of that money into 6-month CDs and 12-month CDs. So we actually just purchased a 6-month CD and a 12-month CD for some of our sinking fund money that we had in our emergency fund. And we even took some of the emergency fund money and moved it into a CD. I've also bought some T-bills, guys, because the T-bill interest rate right now, when I purchased my T-bills, was over 5%. So I've locked up that money so that way I can get that guaranteed interest until that vehicle matures. And the reason that we put some of our money, our emergency money, in a CD is because I feel like we've already had our emergency. They say that emergencies, when they do happen in threes, and we've already had 3 emergencies that we're hoping we don't have another emergency anytime soon. So the past 4 months, guys, we've had to take care of our vehicle. Our main vehicle went out. It broke down. We had to have it towed to a car shop, had it repaired. And that was one emergency. The second emergency was when our washing machine died. We had to have it replaced and get a new washing machine because we didn't want to go to a laundromat. And then the third emergency was when my car, my 2008 Toyota Prius, which I used for work to drive to and from work, broke down, and we had to replace the water pump coolant to get it working again. Those were our 3 emergencies, and we feel like since we've already had those 3 emergencies, we're pretty much good. We can transfer a big portion of our emergency fund into a CD, so that way it's tied up and getting a higher interest rate when they do lower the interest rate at the high yield savings account. But we did leave some of the money in the Goldman Sachs account, high yield savings account, because we do want some liquidity, because we know that we are going to need some money for Christmas presents when the holidays roll around. And then we wanted to leave a little bit more money, like an extra $1,000 or $2,000 in our high yield savings account. That way, if we do have another emergency, we don't have to get penalized and or pull the money out of the CD and get penalized for an early withdrawal. But if you are thinking about moving your money into a CD, you want to make sure that you find out what the interest rate is, what term you're going to be locking up that money, and whether or not you're going to need a flexible CD, meaning a no penalty CD. That way, if you do need the money before the term is up, you're not going to be penalized with it. We did a no penalty, or we didn't do the no penalty CD. We went with just a 6-month CD because we knew that we're just going to leave it locked up for 6 months and the 12 months and let it ride, because we want that higher interest rate. Because when you do get a flexible CD, the interest rates are a little bit lower than the other CDs where you know that you're going to leave the money locked up and there is a penalty if you withdraw early. So that's what we did with our emergency fund and our sinking funds. We just put them in T-bills and CDs. That way we can get that more secure interest. As far as stocks, guys, I'm really not changing my investment strategy. I'm going to continue down the path that I'm going. I do have some stocks in the financial sector, and then of course the utility sectors, which might see a little bit better returns when the stock market or when the interest rates drop. But I'm not changing my investment habits. I am keeping a little bit of money on the side, and if the stocks do take a dip and on red days, I will invest a little bit more to get my cost basis down. But for the main part, guys, I'm just going to keep my strategy of just dollar cost averaging every time I get paid from Home Depot, or anytime I have money, extra money that I can put in the stock market. I'm just going to keep investing like I normally do. But like I said, if there is a red day and the stocks do take a dip, I will buy a little bit more, because I love to buy on red days. I know a lot of people think that the red days are a scary day to buy. They'd rather buy on green days, but I'm the opposite. I'd rather buy on red days, lower my cost basis, and know that when the stock markets do recover, then my portfolio is going to be sitting better than it did before the dip. So anyway, guys, that's me. That's what I'm doing with my money. I'm just continuing on. As far as my emergency fund, I did lock some up in T-bills and CDs, because I want to make sure that I do maintain and get the best bang for my buck. And like I said, guys, in the past, I would have just let the money sit in the savings account and not done anything with it, because I never really knew exactly what it meant for retail investors when the interest rate drops. And if you have money sitting in just a checking account or savings account, like I said, guys, that is going to affect you when the Fed does actually drop the rates in September, supposedly, because it means that you're going to be getting paid less interest on the money that you have in those accounts. So if you want any chance of beating inflation and earning the most bang for your buck, you need to start making those moves before the Fed does cut the rates. Because once they start cutting the rates, guys, the banks are not going to wait at any time. They're going to start cutting those interest rates, and you're going to start earning or less interest on your money. So anyway, guys, like I said, let me know down in the comments below, are you planning on making any drastic changes with your money? What type of investment moves are you going to make now that the Fed has announced a interest rate cut? And have you made any moves? And if so, let me know what those moves are. And guys, if you enjoyed this video, give it a thumbs up. And don't forget to subscribe to this channel, guys, so that you can be notified whenever I put out a new video. And until next time, guys, I will talk to you later. Have a great day. Bye.